What's 100 divided by 0?
Infinity?
So with that being said, do not think we are done yet. There are a few more things you need to understand. So stick around. You need to keep watching this video because I have something special for you. So let me go back to illustrate our Fibonacci retracement tool. Yeah, but I've already explained the down ones. I will explain the TP1 and TP2 at the end of the video or towards the end of the video. So let me borrow my Fibonacci from this low here to this high here. We are looking at a buy side market. So we are looking at equilibrium versus discount. Equilibrium versus discount. So if, as you can see here in this example, the market has already respected equilibrium. From this swing low to this swing high here, market price came back to the tip of equilibrium, as you can see. To the tip of equilibrium right here. Right there. Let me even shorten this. Let me shorten this right there. Right there. So that it's clear to all of you guys. So equilibrium here, equilibrium is market trend that is currently being traded in the marketplace. Right here when price is at equilibrium. So we look for impulsive price moves. Yeah, and these impulsive price moves here, like this one here on the daily time frame, these impulsive price moves show displacement. Like this one here, consolidation, this one here. So displacement means there's someone in the market, and that someone is the banks, the pro firms, the guys with the big money. Yeah, the liquidity providers. There's someone with a lot of money to move price all the way with these long, big candles here. Retail traders can't do that. Yeah, we cannot do that. It's only the big institutional guys, the banks and whatever, that move price like that. So you want to see impulsive price moves, and we do not need to know what caused it. We don't need to know what caused this and whatever is happening. We don't need to know what caused that. All we need to see is an impulsive price move. That is part A of the second point. Then part B, we only want price to start retracing. We only want price to start retracing after it forms a high. So when price is retracing, how do we know that? So we need 4 candles. It doesn't matter our time frame. We only need 4 candles. For example, the first candle here to the left, the second that makes the high or the highest candle, the third to the right that moves lower, as you can see, this closes down. Then the fourth candle, the one which is dropping, hence making a swing high. We can also test this on our 4-hour time frame. The 4-hour time frame, well quick. So it doesn't matter the time frame. We need this candle to the left, the candle that forms the high. Then the candle, the first right hand candle that starts dropping, then this other one that closes below this to confirm a swing high. And we do not do anything else as long as price hasn't reached to our equilibrium. So all this price leg here, we do not do anything else. We wait for price to retrace to equilibrium. Remember, I told you equilibrium is midway point of price move. Equilibrium is the midway point of a price move. It is the midway point of a price move from the swing low to the swing high, midway at 50% level. So at the end of the day, if you do not see growth that you want, it's simply because you ignore what I've been sharing all along. So in addition to that, make sure you are still watching this. So as soon as price drops from the swing high to equilibrium, we drop to lower time frames and head for buying opportunities. Remember, this is a buy side example. This is equilibrium versus discount. We drop to lower time frames. So here we start from the daily time frame, as ICT said. We start from the daily time frame. We drop to the 4-hour time frame next. Those that have the 8-hour time frame, but I'm not familiar to the 8-hour or the 6-hour time frame. I know the 4-hour time frame. This is context. These are not buying signals. You have to still go back and study what price is doing around equilibrium or below equilibrium. This is context, not buying signals. We do not do anything till we see a down move after 3 candles. A down move after 3 candles on our daily time frame. The first one, the one that makes a high, and then the one that drops, and then this one that closes below the first candle. So for 4 candles to drop till the 50% level, which is fair value. Yeah, equilibrium is fair value. It's a fair market value. Then we drop down to the from the daily time frame to the 4-hour time frame. Yeah, equilibrium. It's a neutral point. It's a neutral point to a bullish condition. You're not paying anything at equilibrium. You feel me? You're not paying anything at equilibrium. So this is like the daily. This is the higher time frame principle. You do not do anything. Make sure you listen to me. You do not do anything here till price reaches equilibrium. You don't want to incur unnecessary losses, guys. You don't want to incur unnecessary losses. All that is, it's inevitable, man. Wait for price to hit fair market value. Now, when price reaches fair market value, you want to study price on lower time frames for your entries. We're going to do that in a minute. You want to study price on your lower time frames for your entries. And on those lower time frames, at the 4-hour time frame or the 1-hour time frame, whatever you're using, it is not it's context, not buy signals, it's context. You want to study it. Banks buy at equilibrium or less. For example, is an example. So peep this. If steak or meat, whatever it is, in Africa we call it meat. In other countries we may call it steak or whatever it is. If steak was $10, let me say $10 a kilo. Yeah, a kilogram or 2 pounds of steak. If it costs if it costs $10, then it drops to $8. That is discount. Yeah, if you buy it at $8, that is discount. So anything below $10, it's at discount. And price doesn't stay at discount for long. You all know this. Anyone that buys groceries or something of that sort, you know price doesn't stay at discount for a long time. Even if when you're buying a new phone, iPhone Pro or something of that sort. So if the initial price costs $10 for an iPhone Pro, then it drops to $8, it won't stay there for a long time. And that's where the banks buy from. That's why you want to be buying with the liquidity providers, with the banks.